The central bank is a government institution responsible for managing the nation's money and the supply of money through coordinating with the banking system. In the United States, the central bank is the Federal Reserve. The Federal Reserve is mandated by Congress to conduct monetary policy, which performs two essential functions, managing the supply of money and acting as a lender of last resort. Monetary policy refers to the actions made by the central bank that manages the money supply. The Federal Reserve has a twin or dual mandate that ensures price stability while maintaining full employment. The tools of monetary policy. The first tool is the reserve requirement. The reserve requirement is the amount of money banks must hold in reserve. When reserve requirements increase, the amount of money decreases, and this tool is rarely used. The second tool is the discount rate. The discount rate is the interest rate charged by the Federal Reserve for loans through the discount window. The discount window is the lending facility that allows banks to borrow reserves from the Federal Reserve. The third tool is open market operations, and these are sales or purchases from government bonds by the Federal Reserve to open up the market, which basically means that they buy or sell bonds and then implement them into the market whenever need be. Then this is the most used tool of monetary policy. The federal funds rate is the interest rate at which banks choose to lend reserves held at the Fed to one another. Banks are required to maintain a certain amount of reserves. If at the end of the day the bank is short, it always borrows from another bank. Since 2008, paying interest on reserves, the higher the interest rate paid on reserves is the bigger